Good afternoon. This is Mark Espy with MarketTamer.com. I'm also known as the Robin Hood Trader, and we find ourselves on Friday afternoon, the 4th of June, and we're looking at the Dow Jones Industrial Average. I must remind everybody before we begin that everything we speak about here is for educational purposes only, never to be construed as recommendation or advice to buy or sell anything. Please do your own due diligence. Once again, to give you some historical perspective, and past analysis certainly pointed this out, we broke down out of this channel decisively and traded down. Once again, this big flash crash day on the 6th, which was very uncomfortable, and then a trade up and trade down. You might recall from past analysis, I told you that we were in a large channel, but it would probably find a narrower channel going forward. And it appears to me that that's what the index is beginning to do. So right here we're beginning to trade in a range between around 9,800 and about 10,300. There's market symmetry here to support this, because if we take this resistance line and move it across here, it lines up very nicely with the low of the channel that was put in November and December. Also this swing high in early February, and this little flat shelf here that was put in late February as well. So I feel pretty good about this channel in terms of the reliability of it, but it's really hard to say, because when you get a day like today, huge down day today, 323, almost 324 points down today. And a lot of these days, I believe, I heard somebody on CNBC today say that only 6 of the last 20 days have been less than triple-digit trading days, and that's a lot of volatility. The VIX rose by 6 points today, and we're currently just slightly above 35 on the VIX. So there's a lot of volatility out there right now. If we do break out of the channel to the upside, the target would be this swing high at 10,900. Before we would get there, it would be about 10,700 at this swing high that appeared back here in late January. Also the top of this channel at 10,500. I do feel pretty good about this support here. The February 5th low at 98.35 is really a pretty stout low. We also have a low at 98.70 from the flash crash day, and we also have a low on the 25th, which was just very recently here at 97.74. Now if we break down out of this channel, the next target is going to be probably 9,700. And then that would be the first stop, and then the low 9,000, probably 9,400 would be the next stop after that. There's a lot of headwinds out there, and there's a lot of reasons for the market breaking down out of here, so we just need to be nimble. But I'm feeling fairly decent about the support that we have right now. But if it does break down below these support levels that I just mentioned, you need to be nimble. We take a look at the MACD and the stochastics. The stochastics looked like it wanted to bounce up above and coming up out of the oversold area, but it's stagnating. It looks like we're getting a rolling over just a tad. The MACD looked like it, with MACD cross over the signal line, like it wanted to start coming back up here. We also had a retracement back to the zero line on the histogram, which indicates a loss of momentum to the downside, and that certainly wasn't the situation today. But let's see if there's any follow-through with this. It might just continue to trade in this channel, and we might very well begin to stay in this channel for a while, so we just need to watch and see what's happening. But as I mentioned, I did feel it was going to find a level and a narrower channel, and that's exactly what it's doing right now. So let's watch these levels and see what it does. And I certainly suggest in this market to remain hedged. You have to be careful. It's pretty dangerous out there. So with that, we're going to move over and take a look at the SPX.